Hi everyone, my name is Robin Speziale and I'm the national best-selling author of a book called Market Masters. So in another video I have on my YouTube channel, I went through Warren Buffett's entire owner's manual. And he has that on BerkshireHathaway.com. He has 15 principles in this owner's manual. It's a framework of how he thinks about his company, Berkshire Hathaway, and it's also a blueprint in which he uses to, go out and acquire companies for Berkshire Hathaway or to invest in public equities. And there's actually a really important point here. It was point 4 on the owner's manual. Buffett said, "Our preference would be to reach our goal by directly owning a diversified group of businesses that generate cash and consistently earn above average rates of return on capital." So this is what this video is about. And I'll just repeat that last part of Principle 4 in Owner's Manual, where Buffett says he looks for businesses that generate cash, so free cash flow, and consistently earn above average returns on capital. And I'm going to use return on equity and return on capital interchangeably. The formulas are very similar. So for return on equity, short form ROE, you take the net income as a numerator and you divide by the book value as a denominator. And book value is assets minus liabilities. Now with return on capital, there's different ways of calculating return on capital, ROC. But what I like to do, I like to take the same net income as a numerator and then divide by book value, assets minus liabilities. But then in that denominator, you're adding back long-term debt. So what you tend to see is return on capital will always be lower than return on equity. So that if return on equity is, let's say, 25%, you'll find that return on capital will be lower than 25%. It'll be, let's say, 20 or 15%, depending on the long-term debt that company has on its books. And since I read about Buffett's focus on return on capital in the owner's manual, I've also read Buffettology, which explains his focus on return on capital. It just makes so much sense to me. So now when I research companies, when I create my watch lists, when I go to Google Finance or TMX or other stock filters, the first stock filter I use is return on equity. And what I do, if I go to Google Finance, I go to the screener, I clear all the other metrics and I just put in ROE. And I put in ROE for the current year, the trailing 12 months. I put it as ROE has to be equal or greater than 15%. And then I click search, and it searches for all the US and Canadian companies with a return on equity of 15% or higher, so 15% or higher. And I don't want to focus too much on the companies on the lower end, right? You're going to get companies ranging from ROE, the trailing 12 months or the current year of 15%, and you'll get it all the way up to in some cases 100, 110%, and in other cases even higher than that. But I like to add companies to my portfolio that have a high ROE, but importantly that have a consistently high return on capital and return on equity. So if the current year I see that company has a 30% return on equity, then I go to Morningstar.com and I type in that company. I look at key stats and I look at the past 10 years, of that company's performance. And while this year it has 35% ROE, I look to the year before, 2017, 16, 15, 14. I look all the way back to 2007, the past 10 years. I want to make sure that they've had a consistent return on equity, return on capital. And some of the best companies I find, though, are ones that go from 10% return on equity and they grow it to 30%. You have to watch out for the companies that start at 30% and then they start to decline to 15%. So consistency is key in return on equity. So a lot of Buffett's companies in his portfolio, you'll see this. But another important thing to think about is, while a company like Rogers Communications, which is one of the big telcos in Canada, while it has a high return on equity and while it has consistently achieved a high return on equity, it's not it's not growing its revenue, it's not growing its sales at a high rate like it used to. Like a lot of large numbers. It has a large client base. The market is very much saturated, the telco market in Canada. It's not going to generate too much more new revenue, and so that stock price, you're not going to see 25% annualized gains in the stock price anymore for Rogers Communications. And the same goes for any other large company that has high return on equity, has a lot of free cash flow, but there's just not many more opportunities to capture new market share, or there's not many new opportunities to invest in new opportunities at a high rate of return. And so what I like to do, I like to focus on companies that are micro cap, small cap, and mid cap. So companies from a couple $1 million in market cap, all the way up to a company that's $10 billion in market cap. And these are some of the sweet spots in the middle there. And to look at companies that have built a proven business model and that are replicating their success, and that they're able to invest their free cash flow in new high rates of return opportunities internally, or they deploy cash by acquiring new companies and successfully integrating those into the company. And then, as the company gets larger, it starts to buy back shares as well. But it's always using that cash very intelligently. And the point here is that the ROE really is a big tell for how effective managements at these companies are in not only operating their business, by containing costs, but in how they allocate capital. And this is really key. So in Canada, an example of a very good capital allocator is the founder of MTY Food Group, Stanley Ma. So Stanley Ma runs MTY Food Group. He's a big stakeholder in the company. So he wants to enrich himself, obviously, through share price appreciation. And he has a strategy of acquiring these second-tier fast food businesses like Mr. Sub and Country Style, rolling them up, but he rolls them up very well, and then eliminating some of the underperforming stores. But he achieves a very high return on capital and return on equity. And there's lots of other examples of other fabulous capital allocators. But that's what you have to look for in these companies. And the ROE, return on equity, and the ROC, return on capital, are really the best measure. Like in some cases, it's the only measure that I start with. Again, when I go to Google Finance, when I start filtering. And if you want to go a little bit further down the research lane here, when I find high return on equity businesses, I consider, okay, what type of business model is this? What type of industries are they in? I will only invest in companies which are in the technology, consumer, or any type of diversified industry like Savaria that installs lifts on vans to bring handicap and people who aren't mobile up into their van, and also elevators and houses as well. And so these are the three industries, because these three industries, consumer, tech, and diversified, they're not as susceptible to recessions or bad times in the economy. They can largely keep on generating this cash flow throughout. And if you want to do a quick check, if you look at that 10-year table for any company, look at how badly their revenues and their cash flow and other important metrics are hit in times of recession. I love to look at what happened to companies in 2007, 8, and 9 when there was the financial crisis. You'll see cyclical companies just bombed, but a lot of great companies that are well run, that are in the right industries, they just they're still selling the same products. Perhaps they flatlined for a bit, but they still saw growth. And coupled with a high return on equity and a high return on capital over at least 5 years, you need to see consistency. And in my portfolio, all my companies together, they average 30% return on equity. And you also want to see, again, growth in revenue. You want to see continued growth in revenue. I like to see 15% or higher. I like to see growth in the per share metrics, which is all we really care about as shareholders. I like to see growth in earnings per share, book value per share, and free cash flow per share. And all these metrics combined with, again, great management, great capital allocators, and just great prospects for the future, make great stock pick. If you guys have any other questions, let me know about return on equity, return on capital, or anything else. Or if you want my free book on the subject, it's called Capital Compounders. You can email me at r.speziale@gmail.com, or you can go on my website, robinspeziale.com, and you can see more writings on this topic. Thanks, guys, and talk soon.